Let me share with you 3 ways that owning a business can save you a ton of money on your taxes. If you're self-employed, there are many deductions available to you that an average person without a business can't take advantage of. In fact, if you don't have a small business, you might consider the many financial benefits of starting one. Not only do you have an opportunity to earn some additional income, but making an honest effort to earn income from what normally could be a hobby can open up a lot of tax advantages, even if you keep your regular full-time job. So what are some of those advantages? Well, let's start with a home office tax deduction. For 2021, the IRS has simplified the home office deduction, allowing you to deduct $5 per square foot for the space used for business up to 300 square feet or $1,500 a year. If you use more than that, whatever percentage of your home is used for business can be used to deduct from your income, but you really need to keep detailed records. For example, if you rent an apartment and your rent's $1,000 a month and use 30% of that space for business, you can deduct $3,600 from your income, 12 times 300. The catch is that that space needs to be used exclusively, and I mean exclusively, for business. So if your parents sleep in your office on Christmas Eve, you lose out on the entire deduction for the entire year. The IRS is a real stickler on the home office deduction, so you're going to need to keep very, very good records and make sure that you follow the law to the T. Your computer can be deducted as well, also based on use percentage. If you use your computer 50% of the time for business, you can deduct 50% of the cost of the computer. You can also deduct the same percentage for utilities. That includes your heat, your electricity, your internet, and pretty much anything else to support that space. Even a portion of the repairs to your house or apartment can be taken as a deduction in the same percent. It must be a repair that affects the whole house, like a new roof, air conditioning system, or flooring, or is specific to that space which is being utilized for the office only. And you can spend a significant amount of time trying to track all of those expenses. Any money you spend on renovating your home office is also deductible from your income, or through direct expense on one hand, or a 179 expense, which allows you to accelerate your expenses for fixed assets, or depreciation, which means you write it off over a period of time. You can even deduct your kids' allowance by paying them to do age-appropriate tasks around the office like sweeping, dusting, and filing, paying them on a 1099 or W-2, and then additionally you may be able to take that money and set it aside for them in an IRA, allowing for them to get an IRA deduction and tax-deferred growth for many, many, many years to come. So that's number one. That's just the home office. Number two, you've got travel expense tax deductions. You can deduct your business-related travel expenses like hotel and airfare. You can also deduct up to 50% of the cost of your meals on business trips, or even business meals in your hometown. Now, it's absolutely critical that you keep a journal so that you prove that the business-related travel was actually business-related. So you should keep a record in your calendar of who you met with, why you were there, what training you received, how long you were there, how long the training program was, and make sure, again, I use Evernote, but you can scan these things in, keep them set to the side in the event of an audit. You can even have a working vacation and take the family along. You won't be able to deduct the family's airfare, you won't be able to deduct their meals, but you can deduct the cost of your hotel room and just pack them all in. Of course, your family members work for you, and there's a legitimate business reason for them to take that trip, then it's a moot point. You can deduct their travel, you could deduct their meals, you could deduct their airfare. So think about how you engage your family appropriately and legally in your business. And if you're vacationing, make sure you're spending at least part of that time meeting with clients, going to training, or conducting other business-related tasks that are going to be obvious on a calendar and easy to prove. If you only spend 2 hours out of a week on business and you spend a week in Maui, you're asking for trouble. The IRS may disallow the entire trip or may only allow 1 day's worth of that trip. So be reasonable and make sure that the business travel is a predominant reason for your travel if you intend to deduct it. But you can deduct your travel expense tax or your travel expenses when you're traveling for business. And then the third one is automobile or vehicle tax deductions. If your vehicle is used exclusively for business purposes, you can typically deduct all of your vehicle expenses. In most cases, your vehicle will be used for both business and personal, so keep a log for your mileage and designate which trips are personal and business, and then also make sure that that corresponds with your calendar, whether you keep that physically or whether you keep that online. In general, all business travel between business locations is deductible, but your first trip from your home office to your first stop is not, and then your last trip from wherever you're at back to your home is not. Those are considered generally commuting miles. So you're going to want to be careful about kind of where your normal operation is and how you treat those miles. And the IRS is, again, a stickler on the mileage piece. The miles you drive from your home to your office, if your office isn't in your home, are not tax deductible. Those are commuting miles. And again, this is something that a lot of people make mistakes on. You have to make sure you separate those miles out. Deductions for vehicle use can be by mileage or by business use percentage. So if you use your car for business purposes 30% of the time, then you can deduct 30% of your vehicle expenses, and that's calculated by mileage. So if you drive 10,000 miles a year, 3,000 miles of those are for business purposes, then you can deduct 30%, for instance. Or you can multiply your business miles by whatever the IRS's standard mileage rate is in any given year to get your deduction. The standard mileage rate averages anywhere from 52 to 58 cents per mile, and in some cases, buying a used vehicle that has a very high fuel economy rating, like a Toyota Prius, for instance, you could end up making money driving because the deduction after taxes still costs less than it costs you to buy and operate that vehicle. Use whichever method. The IRS will let you use whichever method, whether it's actual expenses or mileage, that provides you with the greatest deduction. So typically your less expensive cars will use the mileage method, and your more expensive cars are going to use a percentage method. Try it both ways. When you go through that process, and if you plan ahead, you can also put yourself in position to maximize your deductions. So for instance, there's a limitation which says, a luxury vehicle limitation, which says that, if you buy a car and a car costs more than $50,000, you're limited as to how quickly and how much you can deduct in depreciation on that vehicle. You're not limited if you're using the mileage method, but you are limited if you're using a percentage method. However, if the vehicle weighs over 6,000 pounds, those limitations go away because it's considered to be not a car, but a commercial vehicle. So that's why you see a lot of contractors and real estate agents and other folks have large SUVs. They weigh over 6,000 pounds. They actually get there's a tax advantage to having that. Now, it may not offset the fuel economy, but if you've got a legitimate business reason to have a large SUV, and you can write off that $100,000 Escalade much easier and much faster than you may be able to write off a $55,000 sedan. So just be smart about how you buy and plan ahead so that you can maximize your vehicle deductions. Having a small business on the side can bring a lot of deductions from a hobby or potential business into your current environment and be able to be utilized to offset your earned income. I just touched on a few of those in this video. With little planning, a significant portion of your rent or mortgage or your utilities, your car, and your travel expenses can be deducted. It could save you thousands of dollars a year. The two things to keep in mind is that business needs to be a legitimate business. You need to be looking to make money. You need to be able to show that you've got a plan to make money, and ideally you are making money. So you're able to translate what your interests are into a passion and that passion into a business. And then you're also going to need to keep very good records of your expenses and attribute those legitimately over to that side hustle, side business, or entrepreneurial business that you've started. By doing that, you can save yourself thousands of dollars each year. The government will subsidize you through the tax system to be able to help you get your business off the ground. And some basic planning right at the beginning is going to go a long way to maximizing your profits down the road. So maybe now it's time to take a look at turning that hobby into a business, turning that passion into a business, and turning the passion that is your business into profits. You might even make some money and have a lot of fun along the way. Till next time, drive to FI.